I do think that the Fed has been a really key driver of a lot of what we've seen so far this year. I think it's perhaps less about the kind of academic thinking in terms of how do I change the discount rate when I value a company. I think it's more just about investors trying to understand at what point tightening monetary policy actually starts to affect the real economy and real demand. You throw in some of the other factors like the war in Ukraine and so on, they don't help. But I really think investors globally, particularly if you look at the US, for example, is quite insulated from the Ukraine. So that focus on at what stage does monetary policy start to have a breaking effect on the economy, the key issue. Now, I think from our viewpoint, the good news is that actually perhaps economies are a bit more resilient to small rises in interest rates than we're used to. You could question whether in the US we're now looking at maybe 450-point hikes over the next 4 meetings being priced into markets. Does that count as small? Not by the standards of recent history, but by the standards of longer history. We think it is something that the US can manage.
See, I don't think they are small rises. When you consider the cost of financing has been at its cheapest historical levels, and let's say we're going from, say, a 0.25 to a 1%, that means your cost of financing has gone up by a multiple of 4, Sunil, as well. So, and these companies and these countries and these individuals have raised so much money at those historic low levels. That's where my worry is. And so, and part, in answer to your question, is 3% the magic level at which a lot of companies start worrying, i.e. 3% is the yield, of course, on the 5 to 30 year at the moment?
Well, of course, companies, as you say, have actually raised a lot of cash. And in some ways, that's given them a bit of a cushion because they haven't just raised it all in short-term debt. We have seen, really over the last 10 to 15 years, an extension of debt maturities for companies that should give them a bit of a buffer and probably means that you won't simply get cliffs where large parts of the corporate sector all need to refinance at the same time. Now, at the same time, there will be parts of the market that have been a bit more debt reliant. And I think if you look at, let's say, the performance of quite highly levered, unprofitable companies, that's been much weaker. You can see that in, for example, smaller companies in the States or some of the high growth sector in Europe as well. So certainly for those sectors, I think investors have been digesting that for a while. But that's why if you look at that kind of unprofitable small cap sector, you've lost perhaps 40% of the value over the course of the last year. So I think investors are trying to differentiate, and I think stock prices are doing a good job of reflecting some of those risks.
So what price are some of these companies worth buying, Sunil? As I look across the S&P constituents down more than 20% from their 52-week highs, you've got businesses like Nvidia, Facebook, Salesforce, PayPal, Qualcomm. It's quite a list. Some of these businesses probably start to look attractive, don't they?
I think probably investors are going to have to just slightly reframe how they think about them. When we look at the weakness of the performance of some of those stocks, again, people are weighing up how to tighter interest rates feed into that, how do growth numbers feed into that. I think the growth numbers are much more important than, again, the kind of arithmetic messing around with discount rates. Because, of course, a lot of the companies you've mentioned are extremely cash flow generative, quite low in debt. That's quite a big contrast to what we saw during the dot-com era from the biggest companies. So I think it does become much more about that growth trajectory that they can achieve. And I think probably for some of these companies, now that they're no longer looking at just doing the same activities, but in more and more markets, but trying to innovate within existing markets, it is going to be a flatter growth profile. And I think maybe to your point about pricing, we should be thinking maybe more about how we priced kind of quality growth franchises maybe over the last 15 years, maybe during the 2000s, for example, when we did sometimes have what looked like high valuations on staples healthcare companies. But I think that might prove to be a more accurate long-term metric for some of these companies than what we've seen over the last 5 or 10 years.